Okay, everyone, welcome to Macro Ace with your host, Tony. We're going to be going through the Bank of Canada, the expectations for the rate decision, the current sentiment surrounding the markets. Of course, you have the Russian gas stuff that we need to go through to help understand how the markets have reacted to that and how that could affect the Bank of Canada rate decision or future prospects. And also, we'll go through what the rate decision is all about. So let's go through what the Bank of Canada rate is first. So of course, it's the highest level of a central bank's tools to be able to restrict or to try and ease money flow within the economy. And of course, the interest rates, if borrowing costs are set higher for consumers and businesses, then of course they will have to pay more back or for any loans that they take out, or pay more when they take out a loan. So interest rates are very, very key within any economy, particularly in the advanced economies. As I said, it's the highest level that a central bank can control money flow within the economy. So a lot of course, we know this already. And if you've been watching my previous videos, what we've seen is that all the central banks have been in a hiking mood or hiking frenzy, going not by 25, not by 50, but by 75 basis points for a lot of the major central banks. So we've seen with the Bank of Canada what they did last time. They did a 100 basis point hike rather than the expected 75 basis point hike, which everyone had priced in. So if you're not familiar with who I am, of course, if you've seen any of my videos on previously, or if you haven't, key thing is Macro Ace is about giving you a better understanding of releases and helping you prepare for the release as best we can, going through the deviations and stuff like that. So if we're looking at where the economy is at the moment and what could factor into the Bank of Canada's rate decision for today. So inflation rate still at the highest since 1991 at 7.6% versus 8.1%. So we saw a tick down in the last month's report for that, which was, if you're trading stocks, Canadian stocks, then that's quite good. Maybe the Bank of Canada will at some point ease off the brakes a little bit and not be too aggressive. Then you had GDP quarter-on-quarter analyzed for the second quarter. The forecast was 4.4%, and we got 3.3%. But compared to the prior quarter, we had 3.1%. So still better than the prior quarter, but wasn't as strong as economists had expected. Then the Canadian employment change, which we've got this Friday. So don't miss that out. Don't miss out on that as well. Canadian employment change last time came in at minus 30.6k versus a prior of minus 43.2k. And if we're looking at average hourly earnings, tick down slightly to 5.4% from the prior 5.6%. The unemployment rate remained unchanged at 4.9%. Also, retail sales as well was at 1.1% versus 2.2%. Then the PPI year on year was at 11.9% versus the prior of 14.3%. And if we're looking at the raw material price index, then that was at minus 7.4% versus minus 0.1%. Key thing to note is that in Canada, of course, inflation is still the key thing that every central bank, including the Bank of Canada, is trying to bring down to the inflation target of around 2%. And that's still quite strong, although we had seen a decline for 1 month. But also other factors as well that leading to the Bank of Canada to go with these aggressive rate hikes is GDP is still quite strong. It's quite healthy at 3.3%. Even though it wasn't as strong as economists expected, as said, it's still quite strong. So that plays into the hand of the Bank of Canada's tightening cycle. And then the employment change is also quite key to understand that although it is in a negative area, it isn't wholly negative where we're seeing a complete destruction of the job market in Canada. You did see slightly better than expected, better than previous figures than we had seen here. So that should give you an overall view where the Canadian economy is. So a mix of data that is strong, and a mix of data that some parts of it being a bit weak. So the previous Bank of Canada rate decision then, so what we had seen from the Bank of Canada back on July 13th. So you had a 100 basis point hike that was taken, which was higher than which was 0.25% higher than the expected 75 basis point hike. The key reason being is that they underestimated inflation, within Canada, and that's why they went with a mega, super huge mega rate hike instead. What they did say, though, is that the baseline growth prediction through 2024 does not predict a recession in Canada, again, which was another reason why they went for 100, and they're not fearing, pushing down on the brakes quite quickly. And they also said that we have, as said, they'd been underestimating inflation since the spring of last year, owing primarily to global factors. That's including COVID. That's also including the Russia-Ukraine conflict, that having an effect on not only oil prices and energy prices, but also agricultural goods as well. We've got to think about wheat and grain. Those prices for those commodities or soft commodities had skyrocketed. Are still quite high at the moment, and they haven't really kind of depressed down enough for everyone to kind of relax or take a breather. Then other areas too. So we've got to bear in mind that they see inflation averaging 7.2% in this year, up from 5.3%. So that's a big old gap. And then 4.6% in 2023, up from 2.8% and 2.3% in 2024 versus 2.1%. Remember, the Bank of Canada's target inflation or goal is 2%. And if their projections are showing that we're not going to be anywhere near that next year, and we've got quite a while away, then it just adds to the peg that the Bank of Canada is going to keep raising rates until they're satisfied with inflation. Master Roy says hello. One more bit as well, and also the other point being is that they said that a severe slowdown in the housing market is underway, with contraction expected to continue the second half of this year and into 2023. Then looking at the previous market reactions, we'll kind of get it over and done with now. Why not? So we'd seen, of course, when the data came in higher than expected for the Canadian dollar, you'd seen that move towards the upside, or you'd seen that strong amount of appreciation from the Canadian dollar against other currency pairs. Now, if you got data that was in line with expectation, or the rate came in as expected, you wouldn't have seen this strong reaction. But because it was above expectation, we'd seen a stronger reaction and more volatility that had come into the market for the Canadian currency. So that's one thing to bear in mind. If we see data in line with expectation, we're not really expecting too much volatility, and we'll go through the deviations as well later on. But if you see data that is above or below expectation, then you're expecting an increase in volatility from the Canadian dollar. Now, Bank of Canada's views then, following the rate decision in August, so we had Macklem, so the inflation may have peaked, and then we had the Canadian CPI data showing that we had seen a decline to 7.6%. It was as expected, but what economists were looking for. Then July 20th, they had Macklem said that Canada's inflation is to remain painfully high in 2022. So both of those comments just showing that that there is a need for strong central bank action to be taken. Other sentiments and views then to consider. So on July 27th, we had TD Ameritrade said that they see the Bank of Canada hiking by 75 basis points in September. And also on September 2nd, you had a poll that said that traders expected the Bank of Canada to raise the overnight rate, or the interest rate that we'll be having today, to 3.5% by the end of 2022, which is unchanged from the July poll that was previously done. So they're expecting, a 75 basis point hike, and then probably another 25 basis point hike here, or maybe a pause at some point. But that's what some of the economists were polled as saying. Then sentiment-wise, right? So this is very, very key and for the future for the Canadian dollar. Now, when we had seen the Russia conflict Russia conflict with Ukraine kick off, all the safe haven currencies and assets had seen an appreciation, right? So the dollar, you'd seen gold fly, you'd seen the Japanese yen, Swiss franc enjoy seeing that rally in that currency. And also crude oil had seen a nice rally too. Now, the key thing is the Canadian dollar didn't see a rally at the beginning of that conflict because everyone's in a risk-off mode, and nobody was kind of sure how long it would last or what sort of effects it will have on the wider global economy. Until we started seeing that oil prices started to rise. Remember, Canada's economy relies a lot on exporting minerals and natural resources such as oil. So when oil prices started to climb, you also saw that the Canadian dollar had also seen an appreciation at the same time as well. Of course, it's a commodity-based currency. So if their main source of export is providing oil to the rest of the world, then that appreciation in oil prices is going to have a positive impact on the Canadian dollar. So that's what we had seen. At the moment, we're not seeing that now. When we had the Gazprom has said that gas transport to Nord Stream pipeline has been halted until flaws are repaired. So you'd seen the Euro weekend, natural gas had risen, of course. Stock indexes, right, across everywhere had declined. So not only the German DAX 30 index, but you'd also seen the S&P 500, the NASDAQ, the Dow Jones also take a hit as well, alongside with the DAX 30 or the German DAX 30, because it's the uncertainty that had been created and how sensitive the energy market is at the moment as to why we had seen that very big negative reaction. Remember, about 40% of energy for Europe comes from Russia, or around that figure there. So having that being removed or paused, part of that energy resource being paused has had a big effect on not only Europe, but also the markets too, taking it in a negative way. So let's look at some of the reactions then. So this was if we're looking at Canada then, so this was the TSX. We had seen a negative reaction after the headline had come out. And then we'd also seen the Canadian dollar futures that also had seen, or 6C, had seen a depreciation as well off of the back of that. So that's one key thing, is that even though, usually when oil prices climb, you start to see the Canadian dollar appreciate at the beginning of the risk-off sentiment, or the beginning of when a conflict occurs, or if there is something that's affecting the markets or globally having a big effect, then the Canadian dollar doesn't really appreciate until later on when things kind of calm down and people see that oil prices are starting to decline. That's what we've seen in the past. I made a video about it too, how, talking about the trading the Ukrainian conflict and how it affected the market. Then going to other bits of sentiment as well. So we had on the 2nd of September, BMO calling for 75 base point hike and seeing the end point at 3.5% by the end of the year. Adding that the Bank of Canada may need to drive interest rates above 4%, partly because the housing market is showing a flicker of life. So that's what BMO says. That's what they see. So remember, if, housing is quite a big part of the economy too. And that's the top level of consumer spending. If you're going to buy a house, that's a lot of expense. That's a lot of money you're taking out, or, trying to use to buy a house for a mortgage. Maybe you want to buy the house altogether. All those sort of things that, at a high level of consumer spending, that is, quite key to see if housing starts to tick up or starts to come back, then that will add to the central bank to tighten monetary policy a bit further than maybe some economists are already expecting. So you'd seen that Toronto home sales bounced 11% in August from the prior month. And again, as said, that any sign they also said that any sign that the most interest sensitive sector of the economy is holding up surprisingly well, it will be a clear signal that more tightening than expected may yet be required. So you've got to say that as the economy is still quite hot at the moment, we haven't really seen a substantial decline in economic activity, in consumer spending, or in demand for housing. So the Bank of Canada doesn't really have any point or any need to start slowing down rate increases at the moment from that data, or BMO are basically saying there. Then, if we're looking at just a piece that I picked up from Bloomberg, they say that, so this is where economists expect the rate to be in the Bank of Canada. So at some point in 2023, they see the Bank of Canada holding at around 3.5 to 3.75% for most of the year, and then they're expecting, economists are expecting the Bank of Canada to start cutting that rate towards the tail end of 2024. We haven't had any indication of, from the Bank of Canada as to, them saying themselves that they'll look to cut rates or, reduce their quantitative tightening or ease off the brake. They haven't mentioned that at all. But the reason why economists are doing this is because they feel that inflation, it will peak in 2023, and then it will start to just then head slowly, ever so slowly towards a 2% target for inflation. And then you wouldn't need such a high rate of interest from the Bank of Canada to be able to get to that 2% level. But that's what economists are predicting or expecting for not only this year and next, but also for 2024 as well. So that's something that's quite interesting just to be aware of. Then if we're looking at other investment banks' forecasts to where they see the rates today, so this is quite interesting. When I was going through this here, so BMO sees the Bank of Canada doing a 75, RBC, Goldman Sachs also 75 today. JP Morgan is looking for the Bank of Canada to do a 50 base point hike to 3%, which is quite interesting compared to a lot of the other economists are looking at a 75 base point hike. So the only reason as to why JP Morgan would look to go for a 50 is that they may be going off of the inflation report heading down to 7.6%, being much lower than the prior 8.1%. So maybe that there isn't as such a need for these super strong rate hikes that we've seen from the Bank of Canada in the past and other central banks as well. Then if we look at the prior rate decision then and see how it reacted. So of course we had the US CPI. This one was a long live stream that I did all the way from 8 o'clock till 10:30ish, I think, Eastern time. So let's have a look at the prior release. Oh, kind of go back a little bit. Oops. Okay, so just make that big screen. Okay, so about a couple of seconds before the release occurs, and what you'll see, of course, is the Canadian dollar flying up in the air, or strengthening, should I say, against all the currency pairs. Okay, so I'll turn my own sound off there. I could hear my own voice, but that's what you could see there, is that the data was much better, was higher than the expectation, right? As I said, everyone was looking for a 75 base point hike. We got a 100 base point hike off of the Bank of Canada's underestimation. Said that wrong. Underestimating inflation from the spring of last year. So that was the market reaction there. We'd seen the Canadian dollar fly up and see an appreciation from there. And if I kind of go forward, and that's basically it. But you can see that that move had occurred there. I kind of skipped ahead forward. Yeah, and all the other currency, the Canadian dollar was still strengthening even after about what we can see. After about 9 or 10 minutes or so. Now, if I bring up the other bit for you, which I wanted to bring up the deviations, which we have plenty of time to do. Let's bring that up here for you. Okay, here we are. So this was the deviation from the how the currency pairs reacted. Okay, so we know that the Bank of Canada hiked rates by much higher than expected. Okay, and this was the market reaction. So the dollar CAD had seen about 80 pips down, and after about 10 minutes of trading, that's what the brackets represent, what the figure in the brackets was down by about 38.5 pips. EuroCAD, 88 pips down, had seen the second biggest reaction compared to GBP-CAD, which had 99.8 pips down. And after about 10 minutes of trading, it was still down by about 64.3 pips. So the reason why the GBP-CAD had such a reaction is because the Bank of Canada is way ahead of the Bank of England with raising interest rates. The other surprising thing was how the Bank of Japan, of course, they're now looking to continue to ease monetary policy, and they're continuing to buy up bonds to keep their 10-year yield in line in their checks. But this is the thing, that wasn't the biggest reaction on CAD JPY. The biggest reactions were from GBP CAD and Euro CAD, going back to July 13th, I should say. So what we could expect now that the Bank of Canada, now that the ECB has done their first rate hike in quite a while, okay, probably not going to see such a strong reaction from the EuroCAD, maybe this time around. We could see a strong reaction on CAD JPY because of the central bank looking to keep easing monetary policy. The Bank of England economists are expecting looking at a 50 base point hike at the next meeting. So that leaves the Bank of Japan, or the Japanese yen, which hit a 24-year low against to hit a 24-year low not too long ago in the week. So that could be the weakest currency, which you could see the biggest market reaction in that area there. But not to leave other areas too. So Swiss franc, it's seen about 52 pips down. The other areas, so Aussie dollar and the New Zealand dollar, about 50 pips down as well. But again, the key thing, dollar CAD, Euro CAD, GBP CAD had seen the biggest reactions out of from the market last time round. And of course, this will mean that with the Bank of Canada, that they have the highest rate of interest out of the out of the advanced economies. So that's also another thing to consider too. So they've been very, very quick, and they have not been afraid to kind of take action when needed. So could that mean what is the probability of a 75 base point hike? Excuse me, not 75 base point hike, a 100 base point hike at today's meeting? Well, it could be quite strong. Knowing how that the Bank of Canada surprised us last time. If they still think that inflation isn't getting under control in their eyes or in their view, then that could be, as said, it could mean that they go with a 100 base point hike, and we see a strong Canadian dollar reaction as we'd seen last time. Now, as said, if data comes in line with expectation, you could see a little pop from the Canadian dollar, and that not to last too long, because a lot of the pricing in had already happened in the past for the Canadian dollar and the expectation of a 75 base point hike. So if it does come in line with expectation, you're probably going to see, you might see the opposite happen. So you might see the Canadian dollar pop a little bit and then reverse and move towards the downside instead. That's one scenario. The other scenario is that if we do get lower than expected data, or a lower than expected rate hike from the Bank of Canada, where they decide to go with a 25 basis point hike, it's taking us to 2.75%. That would shock the markets, and that would mean that the Canadian dollar could see a movement towards the downside instead, and see a lot of weakening if that were to happen, because that's a big shift from going from 100 basis point hike at the last meeting, saying they've underestimated inflation, to saying, nah, probably we need to do a 25 now. We might have done enough at the last meeting. So that could be a very big shock. And as I said, a lot of economists are expecting a 75. So when you do see, expectations, moving away from other investment banks, expecting a 75, we're expecting a certain rate, then that can cause some extra volatility within the markets when those big boys start to start to jump in and play with the market, to try and capitalize on the extra volatility and the surprise data that comes out from the Bank of Canada. Now, other thing to be aware of course, we have the statement as well from the Bank of Canada. So we need to be careful and attentive to look out for the comments that are coming through from the Bank of Canada to let us know, whether again they're still underestimating inflation, whether or not they expect the housing market to continue, whether they see more strength in the housing market, or they still see it being quite slow, or not picking up any growth. That's also another key thing. And of course, the key point is inflation expectations. Do they see inflation expectations, or do they think that inflation will come back into control by the end of this year, rather than seeing painfully high inflation for the rest of this year? Okay, that's those are the comments that are going to be coming through. That's going to be quite important to see how well or how strong or how the market reacts to the rate decision, and how long the Canadian dollar can either strengthen for or weaken for. All right, so that's the prep for the rate decision. Now we have, so of course we're looking at financial juice for the rate decision, and of course that's where we're going to get the live data, real-time headline, real-time voice as well. I've currently got it muted because otherwise it'll kind of it might disrupt the flow a little bit. But that's one thing that we've got to be. Actually, let me just turn it on for myself here. Actually, no, I'll keep it off. It could be a little bit distracting. Okay. Now just bring up my tick strike here too. Okay. So I've got my Eurocard somewhere. Let's turn it off and turn it back on. Okay, so the key areas I'm going to be keeping an eye out for then are going to be the... Turn that off. All right, there we are. So that's if you're unfamiliar with tick strike, then tick strike just measures the amount that measures order flow. Okay, the volume that of buying or selling momentum that's occurring within the market, or a certain asset that you're looking at. So at the moment you can see a lot of red in this negative number here. That's just showing you that there's some selling momentum that's occurring. Now there are key figures here as well. So 1 being the most sensitive, meaning that when there's a bit of movement of buying or selling momentum, then tick strike is going to go off here with a little number going off there. So as you can see, there's a little bit of selling going on. So you can see tick strike going off there. Okay, we've got less than a minute now. I'm going to shush my mush, and we're going to see how this market reacts. Like I said, it's going to be very important to look out for the comments that come through from the Bank of Canada as well for future or for some forward guidance. So if we do get 3.5%, which would be a 100 basis point hike, you'd expect some strengthening from more strengthening and more volatility from the Canadian dollar. Okay. But if it's as expected, not too much reaction. About 10 seconds left to go now. All right, let's see what you're going to do. Okay, there's a hike, 75 basis point hike, 75 basis point hike as expected. There we go. So not much reaction from the Canadian data there. As said, it was as expected. So you can actually see the reverse, the opposite happening now. So you can see the Canadian dollar slightly weaken here a little bit. Okay, there we go. So, yeah, weakening from the Canadian dollar, more or less as expected. It's already a lot of it was already priced in from the Bank of, from the Bank of Canada, from the markets. I'll put it that way. I've also got comments from Fed's Mester coming through too. Literally a second before the release was due. She's saying here. So, Mester delivering identical remarks to M&I as she did in a speech on August 31st. Just repeating that last month's Friday's jobs report suggests the US is beginning to see some moderation, but labor market conditions remain strong. Right, so let's have a look at, let's do some measurements here. Alrighty, so of course, let's go do some measurements. We are not done yet, my friends. Okay, so let's see here. So on the dollar CAD, there's about 17.5 pips down there. CAD. Yeah, so it wasn't too much of a reaction from what we've seen previously, where we had seen as I said, we didn't get anything above expectation or lower than expected. So we didn't see that much of a reaction from the markets. If we look at EuroCAD, yeah, wasn't too bad either, the release itself. It's just there we go. So it's just quite mixed. So financial juice is where we have the live real-time data coming out for you. Okay. And the reason why it's an advantage to have a live voice and text feed or use Financial Juice Pro is because you have investment banks that use the live voice and text feed to capitalize on potential trades and also manage their risk within the market. So that's why it's very key to have a live voice and text feed. You can get a delayed feed, which we do have already on the light version, but on the light version you get adverts, you have a 10-second delay to the whole website. That's including the economic releases, so you're not really able to capitalize on that data as quickly as you can with the pro version. So this is what we want to do with the pro version, is give you a 7-day free trial to be able to have a play with it and to be able to see what kind of suits your trading style and what works for you. But that's there in the comment section there for you that I've pinned in the chat. Also, talking about the Financial Juice website as well, Pro. Now, you can also set your economic release triggers. So when I say that, if we're expecting, let's say, if I wanted to buy the Canadian dollar or wanted to see a big amount of movement or anything for a trigger for myself to kind of trade, then I can set the figures in here for myself. And then what it'll do is that when the release comes out, if the trigger is met, then it'll either show me a buy or sell sign, whatever I kind of set it to. Of course, ignore this number here. That's just showing the forecast. That's not us telling you what to do. But for, let's say I did 3.5%, okay, and then sell if it was 2.75%, right? So 100 basis point and a 25 basis point scenario. And you'd save that, and then when the figure comes out, it would either show up with a buy or sell sign here if the trigger is activated or if it's met. And that's in real time too, whereas in the live version it's not. So again, another reason to be able to jump on and use a live voice and text feed. Try us with Financial Juice. We've got 7-day free trial, so the link is right there. Also, Tick Strike, you can see that go off too. So Tick Strike, as I said, I'll give you a bit more explanation, but I've just popped in the 7-day free trial for Tick Strike as well. They can have it'll play with. So let me explain Tick Strike. Now, when let's say, when Tick Strike goes off, and I've already explained, 1 is the most sensitive level, where you see a little bit of a reaction from the markets, and then Tick Strike goes off, like you can kind of see now when there's a little bit of selling going on. What you can do, if you don't want Tick Strike to constantly go off, you can increase the level, okay, all the way to 15, which is the least sensitive to market reactions. So only when there's a big amount of movement that's going on in the market, buying or selling momentum, whatever it may be, then only then will Tick Strike go off and show you if there's a strong amount of selling or buying momentum that's going on. So that's visually done, and you can also listen to it too. I've currently got my sound turned off, but you either hear like a sound if you've used Tick Strike before in the past, you'd either get that or whatever sound you want to put on it that's available. But that's what Tick Strike is, and as I said, we've popped in a 7-day free trial for you there. Then also with if you like this video, don't forget to like, share, and subscribe to the channel as well. Keep up to date with us. Macro Ace. So with if one of your questions are what was the Excel sheet? What was the deviation all about? How do I get my hands on this deviation Google sheet here that you've got here, Tony? Well, if you sign up to the mailing list, you can get it for free, right? This whole sort of data, if I just close Tick Strike, a whole load of data for different economic releases that we have here, right? That you can have a look at to see how markets have reacted in the past to an economic release, and then you can kind of build up your own, sort of like system, or use it however you want to use the data to kind of see, okay, if X comes in at this, then I will do this or that. Okay? So use it however you want to use it. This is, as said, historical reference of how markets have reacted to different releases. Now that is the deviation Google Sheet is something that I provide for my subscribers to the mailing list once a week on a Sunday. So I'll provide you with the deviations for the upcoming releases for that week, okay, in one email on a Sunday in the afternoon that you can have access to. So that, again, I've put in the link to subscribe to the mailing list and to be able to be a part of that too, and give me your support. Also in the mailing list, you also get the the week ahead for the videos as well, the releases that we'll be covering, the week ahead of what to expect from the Asia session, the European and the US session. That's also included as well. So if I just bring it up here for you, and you can kind of see how that looks. Let's make it bigger. There we go. So that's how the week ahead looks for you, right? So it's not massively detailed, but it's enough to kind of know what to expect there. Of course, if there's more detail wanted, so like the summary of the week in news is something new that I added to the week ahead prep. If that's if you want more stuff in there, then let me know. But as I said, you get the week ahead, what to expect from the different sessions or the different trading sessions, Asia, Europe, US, and the summary of the week in news, and also the releases that we'll be covering for the week. So tomorrow we've got the ECB rate decision, and then Friday we have the Canadian employment change. So, we only select releases that are expected to have, a big market reaction or a lot of volatility that you can actually trade with macro ace. That's what we aim to do. Sometimes there'll be releases that we do or have done in the past, but recently haven't seen too much of market reaction. Like the EIA oil inventories hasn't really seen much of a market reaction in the past since the Ukraine-Russia conflict. So I've kind of paused that and put that to the side. But now there are some releases that are having a bit more of a market reaction, enough to say, okay, maybe we should look at those. But again, it's down to sentiment. What are traders focused on? And that's what here at Macro Race we're trying to help you with. Master Roy says, very informative. Thank you for your service. Real Idiot says, thanks, Tony. Have a good one. Thank you very much, guys. But yeah, so that's basically it for me or from me. And I will catch you guys tomorrow. So actually, let me put in the video for you guys tomorrow, so you can join me for the ECB rate decision, where they're expected to do a 75 base point hike. Just grab that here for you. Un momento. Right, here we go. That is the video for tomorrow. So the ECB rate decision. So that I'll be starting that live stream at 7:30 a.m. 7:30 a.m. Eastern time. Remember, they've moved their time forward for the rate decision to 8:15 a.m. Eastern time rather than 7:45 a.m. Eastern time. But that video is out there for you to have a look at, and yeah, that's basically it. Lakshita says thanks a lot for your effort. Thank you very much. All right, I will see you guys tomorrow. Take care and goodbye. Oh, sorry. I know I should have gone, but one more thing. So if you like trading stocks and unusual activity or unusual volume activity in stocks, then you can join our free beta test group of our new service. So not only stocks, but also currencies, crypto as well, futures, that you can have you can beta test for free and use that product and let us know what we can improve or what we can change or what we can make better. So I've put the link in there as well for you for unusual activity. All right, now it's time to say goodbye.